In this section, what we're going to do is we're going to take the financial statements that we forecasted in the previous section, and we're going to use our forecast to value the company using 3 different methodologies. One of them is discounted cash flow. The other one is price to earnings. And the other one is price to revenue. And using these 3 methodologies, we're going to find a price target for the company. And then what we're going to do is we're going to take an average of all 3 price targets so that we can minimize the error for whatever valuation methodology we use, which is least accurate, usually DCF. So it's a good Wall Street practice. And when companies go public, the investment bankers do this as well to help the trading floor sell the stock. They talk to investors and say, we value the company 3 different ways, usually DCF, price to revenue, as well as price to earnings. And you take the blended average of all 3 just to give investors confidence that they know how to value the company. Now, please use your own analysis for this. Do not rely on me, because I'm going to teach you a couple different ways to do this using your own estimates and your own methodology as well. My favorite way to value companies is price to earnings. Let's begin. Please click on the DCF valuation button right here. Now, the way that DCF works, it stands for discounted cash flow. And it's a way to value a company by saying, hey, how much cash are they going to make every single year into the future? Let's value the company using that. But you have to take one more step, which is if you forecast 5 years of cash flow, what about years 6 to infinity? And that's called the terminal value. So I'll explain all of that from scratch. So these numbers here are in billions, and these numbers here are pulled directly, hence the color green, from our financial statements. So this here is from the cash flow statement. So let's pick this number here, which is the forecast, rough estimate, of course, for fiscal year 2028, hence the E estimate, for $165 billion in free cash flow. So what I'm going to do is I'm going to link directly to that, and it's right down here. So what we're doing is we're taking the free cash flow estimates for 5 years into the future to figure out how much the company should be worth using a discounted cash flow valuation methodology. And this number here is just cash flow from operations minus property, plant, and equipment. So let's go back here to DCF now. So now we know where these numbers here come from. And so we have to take these numbers and figure out how much is the company worth. Well, if I just add these numbers up down here, it says 686 billion. Well, that's not the value of the company, because what about years 6 here to infinity, for example? And what about the accounting for the risk investing in Apple or whatever stock it is? Well, we're going to go through a lot of steps to explain that. And the end result from all this is going to be you taking the DCF data, copying and pasting it. Now, if you do that, it might be a little bit difficult to read. I'll show you. If we go directly here, it's going to look like this. And let me delete this and paste in the version I just created. Paste as picture. Might be a little bit tricky to read. It's not that bad, actually. So what I'm going to do is I'm also going to break it up into different pieces. And as with all the financial statements and data that we paste in here, paste special from Excel, you can always add your own commentary as well. You know, what are your assumptions? Why are your forecasts based on this, et cetera? And so this here is the entire DCF. Please don't be intimidated. I'm going to go through this in a lot of detail. Now, what I've done here is I have a number of steps for you, which breaks this up into pieces. Piece number 1, piece number 2, et cetera. Rinse, lather, repeat. And so I've got step A all the way through, and let me go here to see how many steps there were. Step A through step F. So for step A, what you can do is you can even copy this directly into your statement, into your report here. So free cash flow. So let me delete that and paste special here for step A. So now we have, and you can always just add a frame to this to pretty it up if you wanted to by going to picture format, picture border. As Salvador Dali said, Chris, if you strive for perfection, you'll never reach it. It's good enough. All right, so now we know what the free cash flow is, how much cash the company's going to make each year for the next 5 years. Very rough estimates for educational purposes. So let's move on to step B. Now, in step B, what we're going to do is we're going to calculate, well, what interest rate should Apple pay? Well, Apple is more risky than the US government as an investment. It is what it is. Well, how much more risky is it? Oh, well, let's start with what the US government's interest rate is, and then we'll add some more stuff on top of that because Apple is a riskier investment than the US government, for example. So the way you do that is this. We're going to get what's called the weighted average cost of capital. And the weighted average cost of capital, and don't memorize stuff. Listen to what the words mean and try to understand. That was a silly thing to say. Weighted average cost of capital. Weighted average. Average of what? Well, they can either raise debt or equity. Okay, that makes sense. So how much debt do they have in their structure? Well, they've got about, this is very rough, about 30% of their capital structure is debt. And what I've done is I've labeled these here. Chris, how do you know it's 30%? I'll show you back in the envelope. So let's go to the balance sheet. And what we'll do is for the most recent quarter here, let's go to this quarter here that was just reported. Let's take a look at the amount of debt they have divided by liabilities and equity. So of their capital structure, and this is a very rough estimate, what percent is debt? Well, there's two types of debt. There's short-term debt and long-term debt. So let me get both of them. Equals, and let's go here to liabilities, short-term debt. See, and I labeled it as short-term debt for you. And let's add to that, hold on a second, short-term debt. So equals, I'll just type here, short-term debt plus long-term debt. These two, I love the color coding. So we took liability, short-term debt plus long-term debt. So that's $105 billion. Then what we need to do is we need to divide that by liabilities and equity. And again, it's very simplistic, this example, but I'll divide that here. And we see it's not zero. It's probably like 30% or so. Let's do it in percent. It's 30%, roughly 30%. Great. So that's the percent of their capital structure. That's debt. Back of the envelope, all this stuff. Yeah. So I'm going to go over here. And now we know that 30% is debt. Well, 70% is equity. Obviously, these two numbers have to add up to each other. And I've color coded these as well and tag them up here so that when you create a formula here, you'll see, instead of just seeing cells, you'll see the actual numbers. Great. So first of all, I think what I'll do is I'm going to run through the cost of debt before talking about the cost of equity. So we know that 30% of their capital structure is debt in this hypothetical example, and 70% is equity. So what is their cost of debt? Well, it's 1.4%. Whoa, Chris, that's way too low, isn't it? It's weighted, and I'll explain why in a second. So let's go down here. The cost of debt, the way that you calculate it is you get the cost of the debt for Apple, which is 5.5%. How do I know that? Well, you can always do a search on, let's go here, Apple corporate bonds. Let's go here. That's really 5.5. It's marked up. I'll show you. All right, so let's go here. Yeah, so it's about 5.5%. Okay. All right, and so 5.5% we'll put here, which I did here, and it's blue, so you type that in. And what is the tax rate? Well, it is what it is, but Apple pays only 15%. Where did I get that from? Let's link directly there. Right down here. And let me unhide this so we can actually see. It's 15%. And that's the most recent quarter for that. All right, and let me hide that there. Really good cash management, actually. So now we've got here in the calculation of the cost of debt, we've got it, which is right here. It's the cost of debt, which is right here, 5.5%, times 1 minus the tax rate. Why do you deduct the tax rate? Because you get a tax break for issuing debt, right? So before you calculate taxes on your income statement, you deduct debt first. So you have to account for it that way. And so the cost of debt is right here. You take the assumed cost of debt of 5.5%. times 1 minus the tax rate of debt. So the cost of debt for Apple is 4.7%. Now, why does it show up here as only 1.4%? Because 30% of the capital structure is debt. So what we did here was we multiplied that times 0.3. if 100% of their capital, say Apple wasn't a publicly traded company and they mainly had debt and no other ways to raise capital, hypothetically, well, this would be 100%, in which case the cost of debt here, we would multiply by 0.3, we multiply it by 1, 100%, and that's 4.8% down there around it. Okay. All right, so now we talked about the cost of debt. Now, when you calculate the weighted average cost of capital, meaning what interest rates you discount Apple cash flow at, there's two components. There's debt and equity. We already talked about debt, which is easier than understanding equity. Equity is fun to understand, though. So the cost of equity for Apple is 9.9%. How do we calculate that? Well, let's follow the green arrow down here. Well, what we do is you always start with the government interest rate, the lowest risk rate in the world, which you can use U.S. Treasuries. So in this case, it's 5.3%. I can't just leave you hanging there. I got to show you where I got it from. So the way that we find that is we go to the United States Treasury's website, which is treasury.gov. And then what we do is we go here to data, and we go to what's called the yield curve. Now, a yield curve usually looks like this. On the x-axis, you've got time, okay? 1 month, 2 months, 30-year. On the y-axis, you have the interest rate. And a healthy yield curve usually looks like this. It's low now, but high later, meaning interest rates are going to be higher in the future. And that's a healthy yield curve because it's basically saying that, well, if the market expects interest rates to be higher in 30 years, it's a good thing because the economy is going to be so good in the future that the government's going to have to raise interest rates to slow it down. But what we have right now, as of the recording of this, and this is late 2023, what we have is what's called an inverted yield curve, which is the opposite of that, where rates are higher now, but lower later. And usually, but not in all cases, that predicts a recession is coming, or things are not going to be as good in the future. Because if rates are higher now and lower in the future, it means the government in the future is going to think to themselves, my goodness, things are not going to be as good in the future. Therefore, they're going to cut rates. And that's what the market is modeling right now. So let me show you the data here. So let's go to, see, the current month. And I will go to November 2nd. Probably have November 2nd data already. I have the 3rd already. Great. Excellent. So right now, the 1 month interest rate is this, 5.5%. And the 30-year is lower. That's an inverted yield curve, right? It's not as extreme as it used to be. It was much more pronounced, I think, a couple months ago. But it's basically saying that there's a good chance we have a recession in the future. Not 100% chance. But rates are higher now and lower in the future. So lower in the future means that the government will have to, my goodness, the economy won't be doing as well, so I'll have to cut rates. And what you can do, actually, it's fun. But if we go back here to a couple of years ago, some random year, and we apply, you're going to have what a more normalized yield curve. Did I do something wrong here? Let me try again. Oh, here it is here. A more normalized yield curve. So if we go back to January 2nd, 2015, we had the 1 month rate was nothing, and the long-term rate was a lot higher. So it looked like this because people thought, well, in the future, things are going to be good, so they'll have to raise rates. That's a normal yield curve. Of course, we have the opposite of that right now. And this impacts our lives so much, man, because if the 30-year rate goes up a lot, then that means that mortgages for us are going to go up a lot. So mortgages right now are 7 to 8%. And that's because mortgages quite often are based on the 30-year. Why 7 or 8%, Chris? I see 5% here. Because we're more risky than the U.S. government. So what I'm doing right here is I'm getting what's called the risk-free rate, the lowest risk investment. And then what we're going to do is we're going to use that to calculate what Apple's rate is going to be for the cost of equity. Great. So let's take 5.5% here. And let's go back here. 5.5, 5.3 is fine. I have to be more accurate. And great. So we have that. So the lowest risk rate is U.S. government. And I take the 3 month. You can take 10-year if you want. It's up to you. And now what we're going to do is we're going to calculate the cost of equity. Well, what is the cost of equity for Apple? Well, we have to incorporate the lowest risk rate, which is U.S. government, risk-free rate, and then add more risk to that. How do we do that? Well, there's something called beta. And what a beta is how volatile a stock is relative to the market. So the S&P 500, big index, 500 stocks that comprise US economy, has a beta of 1. Just accept that. And if a company has a beta of 2, that means that whenever the S&P goes up 1%, that stock will go up 2%, and vice versa. And so companies with high betas, like really high betas, like closer to 2, are very risky, but they do very well when the market's going up a lot. Companies with low betas don't go down as much when the market's going down. And so the market has assigned a beta for Apple of 1.31. Let's see if that's still accurate. 1.23. I actually saw the data yesterday, and it was exactly 1.31. So that's what I'm going to use. I'm going to use, actually, no, I can't. It says 1.23 here now. All right, that's what I'm going to use then. 1.23. Great. And what is our assumption for the stock market return? Well, historically, the stock market, the S&P is up, close to 15%. Let me be conservative here, and I'll say 12%. So the U.S. government debt rate, the risk-free rate is 5.5. Through all this calculation, Apple's rate is 13.5, their cost of equity. How did I calculate that? Well, I started with the risk-free rate, which is 5.5%, plus the beta of 1.23 times the market return minus the risk-free rate. And that gave me a cost of equity of 13.5. So now we have that right here. We actually calculate, we take 0.7 times that number below, and we've got our total cost of capital here is 10.85%. Now you can use this to discount these cash flows here. But before we go there, let's go back to our research report here, and let's get step B and paste it here. And of course, you remove all the instructions in the Word doc. So here, copy, and then here I'll paste special right here, paste as picture. Great, that's done. All right, now what we've got, and we also did the cost of equity here, pardon me, which I'll add in as well. So I'll go to, you can just copy and paste this if you want to, this step here and this below that right here. And yeah. All right, next up, we've got step C, which is the net present value. So what net present value does is it calculates what all that money is we're going to make in the future is worth today. So the easiest way to understand present value and future value numbers is this. If I gave you $100 today, and I told you in the future, you would get 10%, you'll get a 10% return in 1 year. What is that $100 worth in 1 year? It's worth $110. Now, if we're a year into the future and you have $110, and I say, let's do the opposite of what we just did. Let's calculate the present value of $110 using the interest rate of 10%. It's going to be 100. So there's something else called the that layers on top of that called the net present value, which basically does the exact same thing, except it looks at not just 1 year in the future, I mean, not just discount the $110 of today, $200. It looks at multiple years. And we can use 10% or any rate we want. And here's how you do it. There's an amazing formula called NPV. And net present value is basically, it gets all the free cash flow rates with the interest rate that you set. So basically, and let me calculate here. So I'm going to go, if I highlight these numbers here, these cash flows, and we know a company is worth how much cash it can make in the future. We see down here, the sum is 686. But I can make money by putting my money into other investments. So I have to discount that future value into today's terms. If that sounds complicated, think of the opposite of I give you $100, it's worth 110 in 1 year. Well, what's 110 worth today? $100. So here's how you do it. So you type equals NPV. Then what you do is you select the rate. So in this case, the weighted average cost of capital rate is right there. And then it says, thank you. Now it's saying, well, what are your values? And so I highlight the values here and I discount that back to today. And that's $500 billion. We're not done though. We have one massive step to do after this. So let me show that to you again. if I were just to do the net present value and an interest rate of 10% for this, roughly what do you think it's going to be worth? About $100. So think of the opposite of that. Or build on top of that with multiple selections. So if I actually had these selections here at a 10% discount rate, it'd be that. But Apple's cost of capital is higher than that. It's 10.85%. So let's replace the 10% here with this down here. It's lower. And the math for that is basically, and I color coded these and I also tagged these. So this here is the WACC, weighted average cost of capital. And this here, watch what happens up here when I highlight all 5 of these. This here is the free cash flow values. So the net present value equals NPV, the weighted average cost of capital, there, comma, we can highlight or just type here, free cash flow values, enter. So this amount here, discounted with that, is about $500 billion. If I don't discount it, it's $686 billion. Great. So let's go down here, and this is exactly how I calculated this. Now, you'll notice sometimes I'll put if error on the outside of things, and that's because I don't want you to get confused if there's no numbers here, right? So NA. Otherwise, I would say error. Great. So what you can do is you can now take step C here. You can copy, and then you can go down here, and I showed you the math here as well. You can just delete one of these and then paste it in and then add your comments if you want. Well, Chris, you explained what this all means, but what about this value here into the future? Meaning years 2029 to infinity. Well, we can calculate that using something called the terminal value. And I'm not a fan of DCF, mainly because of what I'm about to show you, but I have to teach it because it's important to understand discounted cash flow, especially if you buy an apartment that you want to rent out to somebody else. So years 2029 to infinity. What do we do with that? How do we calculate that? Well, there's a formula for you called the terminal value, which is down here. Calculate the terminal value. And the way that you calculate years 2029 to infinity is you basically take the final year estimate, which is this. Then you grow it by the long-term growth rate, which you can make 1%, 2%, or 3%, because companies cannot grow more than 1%, 2%, or 3% in the long run. I promise you. Just think of the U.S. economy; it's so big it can't grow that more than 1%, 2%, or 3%. So what you do is you grow that one more year, and then what you do is you divide it by the WACC minus the long-term growth rate. And that will give you what this value is here, meaning years 2029 to infinity. So again, the way to calculate the terminal value is you take this last year's value here, which I called final year free cash flow estimate, and you multiply it by 1 plus the long-term growth rate, which I wrote here is, see down here, 3%, because I'm bullish on Apple, I guess, in the very long run. Then what you do is, and let me click here, you then divide that by the weighted average cost of capital minus the long-term growth rate. And you might think to yourself, wait a second, Chris, what if a company has a weighted average cost of capital of 1%, the long-term growth rate is 3%? It's impossible. It just is impossible to have a weighted average cost of capital that low. Great. So we did it. So this is the terminal value, meaning in 2029, what the year 2029 to infinity's cash flows are going to be. Ridiculous. Because this cash flow here discount is like $500 million, or pardon me, is $500 billion. And what we just calculated here, is multiple times more than that. It's over $2 trillion. This is one of the problems with DCF, which is why I'm not just going to value this company using DCF, but in lectures coming up, we're going to look at other valuations like PE, my favorite, as well as price to revenue. Great. Okay. And you can change this rate if you want to. You can make it 1%, and that's going to look how much it changed that by. Yeah. Now what we have to do is, because we have this number here, 2029 to infinity, what we have to do is we have to discount that into today's terms. So the way to do that is you take the terminal value divided by 1 plus the weighted average cost of capital to the power of the number of years. You can make this 4 or 5 if you want. Yeah, that's how you discount it. So now that we have the terminal value, we go here to step D and we copy this, and then we can paste this directly down here into our research report. All right, the next step is going to be step E, where we're going to calculate the target price. Well, now we know what the equity value is going to be of the company based on our estimates. So if I double click this, it's basically this, which is the net present value of these cash flows here, plus the terminal value discounted. And that equals this amount here. Then we deduct the debt that's on the balance sheet, right? So I deducted short-term plus long-term debt, and it's green because it links directly to our balance sheet. And this gives us a target value of this amount here. Then we take the number of shares, which is from our income statement, and I can always link to there, down here, from our income statement. And then what we're going to do, let me just scroll down here again, sorry. Then now that we have the number of shares, we can take the target value of the company divided by the number of shares to get us a target price of 117. And before moving on to step F, what we can do is we can go here and we can copy this and add this to our report here. So you just paste it down here. And so our base case valuation here is $117 based on a growth rate of 3% in the long run and a WACC of 10.8%. Now, this here is what's called a sensitivity analysis. And what we do here is we look at what is the target price going to be based on different costs of capital, WACC, and different growth. So the most positive thing in our analysis would be to use a growth rate of 3% and a very low weighted average cost of capital. And so what I did for this cell here was I just took 300 basis points or 3% off for each one and added 3% here as well. And this here calculates, please don't be intimidated by what I'm about to show you, but it calculates the target price based on a lower cost of capital and a higher growth rate. So we know intuitively that if the cost of capital is lower, then our target price is higher. And our most bearish case is right here. If the cost of capital is 17%, 16.8, which is 600 basis points or 6% higher than what it is right now, and with a growth rate of 1% longer term, which would mean a tiny, tiny target price. And so, as you can see, there's a lot of unknown elements when it comes to doing discounted cash flow. It's my least favorite way to valuing companies, but it's important to understand cash flow and the whole process of discounting cash flow in general, because if you thoroughly understand the future and present value of money concepts, then you'll be a great investor long-term, and you'll think long-term when you invest as well. So our final step here for DCF is we're going to go to step F, sensitivity analysis, and then we'll go over here, and then we'll go here to step F, and we'll paste this directly here. Paste special. Good, and it will look better for you once I'm done with this course. Thank you. And we're now done with DCF. Add your commentary here if you want to as well. Thank you. Let's talk about valuation using price to revenue. So per this graphic here, you'll see that when you click on this tab here called Other Valuations, step 7, let me get more real estate here, but there's a couple of different parts to it. Part 1, as I wrote down here for instructions, you enter in the stock price. And then within part 1, you can also enter in your cost of capital. And what that means is whatever you want to discount, the amount of money you're going to make in a stock to today's terms, you can use that discount rate, meaning 5.5%, or you can use the weighted average cost of capital. And I'll show you how to do both in a minute. Step 2 right here is calculating price to revenue, which we'll do in this lecture. Then in the next lecture, we'll do step 3, which is price to revenue. And then we'll talk about the blended average target price of all 3 methodologies and our final, what's called just right target price. And I say just right because I give you 3 different ways to value within each of these 3 ways using bearish, neutral, bullish. neutral being just right. And you can always make your own assumptions. So let's now move on to price to revenue, which is valuation methodology number 1. So you're going to enter in the stock price here. Let me actually go and get the exact stock price right now, APL. So Apple is this price right here. So I'll take this and I'll paste special right here. And then here we've got the implied market cap. So the implied market cap takes the number of outstanding shares times the price. And this information, you can always just double click on it or go to see where I got these details from. You can always take this here like this. Don't forget to include the little quote and then paste it here to jump directly to that in my spreadsheet down here. So that is the number of shares as of the most recent quarter. Actually, I should probably change that from 2024 to right now. Yeah. So I'm going to change that really quickly. And I will select this number of shares right here. Great. Good. Okay. So that is the market cap. So the market cap is $2.7685.5 trillion. Let's see how close we are. 2.76. That's close enough. Good. Great. It might be slightly off because after hours, it's up a tiny, tiny amount. Great. So now we have the implied market cap. Now, when it comes to your cost of capital, if you want, you can just use the WACC that you calculated before, or you can type in the current government rate, 5.5 or 5.3%, whatever it is for 3 months treasuries. Completely up to you. I'm going to give you the flexibility to decide what to do. All right, so with price to revenue, what we've got here is the revenue from all of our estimated numbers. And again, this is just a sample estimate. Don't use this as investment advice at all. This is educational. So 420 here, that's going to grab it directly from up here. See right there, 420. 460, 503, this 598.9. Remember that number? 598.9 rounded up. Yeah, that's fine. So we've got the revenue numbers for each year. And we've got the revenue growth here as well calculated for us from our income statement. Now what we do is this. What we're going to do is we're going to value the company using a price to revenue analysis. And a lot of people like to do this for companies as a way to get a sanity check to see if their price to earnings estimate is way, way off, et cetera. And some people value companies based on a price to revenue multiple basis if the company is not profitable too. It's the only way to value the company based on this year's numbers. But it's a good way to slice and dice and add diversity to our target price blended average down here. All right, so what we do is I wrote here a bullish target price using a price to revenue multiple of 8, a bearish target price of 4, and just right of 7. Now, these numbers here, I'll leave it up to you to decide, but it's usually based on the sector you're in and the market environment. And it's subjective, but you can use data to back it up. So for example, during the summer of 2012, 3 great cloud software companies went public that I participated in size. One of them was ServiceNow, ticker NOW. The other one was Workday, ticker WDAY. And the other one was Splunk, ticker SPLK, which just got bought by Cisco. And those 3 companies, when they went public in 2012, they were cloud companies. And the going rate at that time, it's relative, of revenue multiple for those companies was between 15 and 20 times revenue. Way higher than we're modeling for Apple here, because Apple's growth rate is not as high, obviously. So it's completely subjective. You can look at similar companies to calculate what price to revenue multiple you think is correct. Now, the way that I set this up is this here is the bullish revenue multiple. And so if I changed it to 12, you'd see it's going to impact all these numbers here. And I formatted this cell here so that it's going to type, if you type in a number, it's basically going to say times revenue. Okay, so let's just leave it at that number there. And so the price target for this year here by the end of 2024, using 8 times revenue, is going to be $217 per share. Now, the way that I calculated that was this. Remember, this is the revenue number that year. I take 8 times the revenue for the year, 420 billion in this example, and that gives us the market cap. Then what I have to do is I have to divide this by the number of shares as well. And that's going to be the number of shares for that year. So this here is going to be the number of shares in 2024. And let me just double check to see if this is correct. You can always copy. Remember to copy right at the quote all the way over. Copy. And we go up here and we paste this in. Good. That's correct. 2024. Now let's go back here to our valuation. Great. So that is the price target for the company as of the end of 2024, using 8 times revenue. We do the same thing for each year going forward, and I'll explain why in a second. So for example, right here, by the end of 2028, we think the price target on a revenue multiple basis of using a revenue multiple of 8 times is going to be 8 times that revenue number. And then what we do is we take this, we take the market cap divided by number of shares to get the price per share. We do the same thing for a bearish price target. You can even make the number lower if you want to. A bearish price target using a lower price to revenue and do the exact same calculation. You can always double click for more details on how I calculate each one of these. Remember, green means it links to another sheet. And then here I wrote the just right. So I chose 7. You could have chosen 6, 7.5, whatever you want to choose based on your research and looking at similar companies in the sector. And so basically what I got was a target price here for year 1 of $2.939 trillion for the market cap. And this here is basically 7 times revenue. And then price per share, what I did was I took this here, I took the market cap divided by the number of shares to get the price per share. Now, this number is important because I like to use my just right methodology when I value companies, unless I'm really bearish on the markets, but I'm usually pretty neutral. And so out here, what I did was my just right target price of 7 times revenue here is based on 7 times revenue in fiscal year 2028. That's like 5 years in the future, roughly. So I've got that target price here, or target market cap, and the target price per share is just the market cap divided by number of shares. Then what I do down here is I'm going to discount the 2028 just right target price into today's terms. And the way I do that, and you can do it any way you want to, is I basically said, okay, let's get the target price in 5 years and let's discount it over 4 or 5 years to here. And I pulled this right here. You can make this equal to the weighted average cost of capital if you want to. I'm going to leave that up to you. And that's how I got that target price right there. And so this explains price to revenue. One more step. We're going to go back to our Word documents. And I'm going to scroll down here. And we're going to select valuation, price to revenue, and throw it in right there. So we'll go here, valuation. This is fun. Price to revenue. Copy. And then we'll go back over here and we'll paste special into our documents. And you can add additional commentary if you want to on your price to revenue target here. And we are now done with our price to revenue target price portion of this research report. Let's talk about our price to earnings target price. So make sure you're on step 7 here and you can scroll over here. And what we're going to do is we're going to value the company using a couple different methodologies. And you don't have to enter any information here. It's all done for you automatically. You just pick whatever target price you want based on this. And let me explain how this works. So when you value companies, companies that have high PEs, it usually means that earnings is growing fast. Companies with low PEs, it usually means that earnings is not growing fast. And so the average company in the S&P 500 historically trades at 15 times and it has, 15% earnings growth. So that means a price to earnings ratio of 15 divided by a growth rate of 15. That's a PEG, price earnings to growth of 1. So I did that right here for this analysis. So I wrote a bearish target price would mean that Apple would trade at 1 times its growth rate for a PE. I'll explain the math in a second. A bullish target price would be that Apple would trade at 2 times its earnings growth rate. And the just right one is in between, 1.5 times. So let's talk about the mathematics behind this. So right here in 2024, we've got 15% earnings growth to a very rough, for educational purposes only, estimate of this amount here. And this 15%, let me show you. It's right down here. See, 15% down here. Then we got 13%, 14, whatever it is there. So these numbers here, the year-over-year earnings change, is going to be reflected right here. And it's green because it's being pulled from those other tabs. So now that we have that, let's explain this target price right here. It's the easiest one to explain. So right here, I've got a target price of 105. That's a bearish target price. And what that will do is it will assign a P multiple of 15 times, meaning 1 times the growth rate. So the math behind it is we take earnings per share times 15% times 100 to make it 115. And that is going to be the price target that year. Okay, so that's going to be based on a P of 15 times. This will be a P of 13 times here as well. Then I take the market cap. Okay, now the market cap, we know, is just the price target times the number of shares. And it's the same number of shares we used over here as well. Hold on a second. Go here. Yeah, AF66. That's the number of shares for that year, number of shares for the year after that, etc. The same thing here. That year, the year after. Great. So that's how you explain that. And so if we look at a bullish target price, let's say a bullish target price in 5 years or 4 years, it's fine, depending on what month you're in. So at this point here, we calculate a market cap of $4.4 trillion. Very bullish. Why is that very bullish? Because it's actually using 2 times the growth rate. So it's 26 times earnings. I think Apple now is 27 times or something. Yeah. So that's what it would calculate at, 2 times. And then here you get the market cap, which can be calculated by using the price target and the number of shares. Now, the just right target price, I had it here at 1.5 times. And what that means is it's going to value Apple at 1.5 times its earnings growth rate. So for example, over here, by 2028, we got 1.5 times the earnings growth rate times the earnings per share. And that will get us to a target price of that, a market cap of that, a target price of this. Then what we do down here, similar to what we did before, is we're going to take that price and discount it over 4 or 5 years, depending exactly what month you're in. We're going to discount that back in today's terms. You can use this number here, or you can say equals WACC up here to change it to the weighted average cost of capital that we use when we discuss DCF. And that gets me to this target price here. And now what we're going to do is we're going to go here to valuation price to earnings, and we're going to copy this, and we're going to insert this directly into our document right here. And then what you can do is you can add additional commentary below this based on your assumptions and much, much more. When you do this, it'll look much better than that. I promise you, it'll be prettied up. And now we're done discussing P to E. Now let's discuss the blended average target price. So I pulled forward here these 3 numbers. They're green, meaning they came from a different tab. So I took from the DCF valuation our bullish case, bearish case, and just right. And just right is here. And so what we do is we look at the DCF bullish, bearish, just right case. These are green, meaning they're pulled from the other tab. And now we have the target price from all 3 methodologies down here. This is price to revenue using the just right methodology. Right here, this is price to earnings. Right here, this is DCF. I'm not a fan of DCF. And then what we've got here is the average target price for all 3 methodologies right here, which is just an average of those. And then the average to the target price from here. So congratulations, we're now done with valuing this company. Always use your own estimates. As a next step, what I have to do is take this, copy, and then I will go directly here and paste this into our average valuation. You can paste in the DCF there as well if you want to, but I'll just paste this down here. And then you can add your own comments as well. I hope you enjoyed this process as much as I have teaching it. Thank you.